we're gonna dive into it. I'm sure I see some new people joining as we go on. So looking forward to having a great presentation today and a great topic. Very timely, of course. Everybody is obviously aware of AI is starting to change our lives in very noticeable ways. And as part of that, really most people know Chat GPT, which is the company's name is OpenAI. But they have a very strong competitor, in some ways the competitor, which is called Anthropic, but their consumer brand name is Claude, has matched their abilities, or in some cases even exceeded them. And so they've gotten a lot of usage. And so both companies had announced earlier this year that they were going to go public. And so this was very exciting for investors. And it's the same year that SpaceX also announced that they were going to go public. So together, these would be by far three of the largest IPOs in history. And for those who follow these things, IPOs means initial public offering. So this is when a private company goes public by selling shares to public investors. And once the shares are sold to public investors, they get traded in the stock market. And so that allows anybody who has a brokerage account to buy or sell their shares. And what's unusual about these companies is that they're coming public at very high valuations. In general, in the past, when companies go public, they're not valued in the $1 trillion range. I mean, in general, companies go public, they're 10 billion, 20 billion. So among other things, these companies are much more highly valued in a very short period of time since they were founded. And they're going public at a time when the market itself is quite robust, and there's a lot of momentum chasing and excitement. So we're going to cover a lot of different aspects of this AI revolution, including investment implications. And we're going to obviously talk about OpenAI and Anthropic as two of the companies that are going public. Both companies filed what's called a confidential registration. So they get ready for the IPO confidentially. They don't share their information. And then after a period of time, they decide if they're going to go ahead with going public. It looks like Anthropic is going to go public this year, and OpenAI was talking about going public this year. I've seen rumors and articles saying maybe they would delay it, but maybe they won't. And so this is a very timely topic and a very timely presentation. Let's go to the next slide. So just quickly to introduce ourselves, for those of you who may not know, so I'm Ken Majmudar. I'm the founder of Ridgewood Investments. I won't go into a lot of detail, but I spend most of my time thinking about investments, thinking about long-term investing. I studied Warren Buffett. That's how I learned and learned the benefits of value investing and investing in quality companies. And my co-presenter is Sam Namiri, who's my partner, and he works with me. Sam, do you want to introduce yourself?
Yeah, I'm Sam Namiri. I'm a partner at Ridgewood and work alongside Ken a lot on the investing and also client associate side. I would just kind of add our perspectives. Ken being a former investment banker, and I used to be at a hedge fund. During these IPOs, the investment banker goes around with the company and kind of pitches the company to the funds. So we come from both sides of the seat effectively when it comes to these IPOs, because I would be sitting at the fund where these companies would come around with the investment banks where they would pitch the company to us as an investment. And that's one of the ways that they figure out the pricing. We'll go into more of that detail, but I think we have both sides of the table here when it comes to these IPOs and the perspectives.
Yeah, and just one other note, educationally, I have a computer science background, so as is someone who is technically quite aware, of course that was many years ago, but the foundations are there. I really do understand more than most how the actual underlying technologies work, and that's a very helpful advantage because a lot of people kind of gloss over that. So let's get into the presentation. I mean, we're living in an exciting time to be alive. I mean, I'm going to date myself here, but obviously, I was not really that old when 2001: A Space Odyssey came out. That was really probably one of the first popular ideas of AI, which was this computer that was HAL that kind of went rogue. But I was very much a teenager when Knight Rider came out, and they retrofitted a Trans Am to be sentient, and that AI was called Kit. And I wanted to add a contemporary example. So for those of you who have watched an excellent movie, one of my favorites, Interstellar, there are these two very nice, very helpful AI robots called TARS and Case that were pictured here. And what's amazing to me, though, is that what I dreamed about when I was young, thinking about doing computer science, um, is now is now on the threshold of becoming a reality. So obviously, we all have Siri. I have two Teslas. Autopilot is excellent; does probably 98% of the driving if I choose to let it. Um, the kind of big consumer moment in AI that's bringing us to this point is, of course, ChatGPT. I remember it was the fall of 2022, so we're not quite 4 years. It released the first really very good AI chatbot to the public, and you could tell that it's basically kind of intelligent. And we're still, it's not quite here, but robotics is going to come. AI is gonna revolutionize healthcare and many other fields. So it's really neat. It's a time of tremendous advances and opportunities, and it's not science fiction anymore. The future is here.
So type me in the chat if you watched Knight Rider at one point.
I did. That was one of my favorite shows when it was out. So there's many implications here, and we have so much to cover. We're not going to cover everything, and there is a report at the end that we're going to um, uh, offer you guys if you want to get it as additional value for being here on the webinar. But one of the exciting things about this AI revolution is that it's going to create, I believe, over time, over the next few decades, a revolution in many, many different areas with huge implications. Unfortunately, that's going to lead to a lot of change, which will be socially difficult also. But I do think that we are on the threshold of a productivity revolution. And we didn't put it in here, but I'd say that for thousands of years, the economy hardly grew. And then as the Industrial Revolution started to happen, economic growth started to go up. And in the modern era, like call it the 20th century, the economy grows roughly 2 or 3%. The US economy grows roughly 2 or 3%, which has led to all this abundance that we see in our lives. And the gating factor is figuring out, is intelligence, is how do you figure out how to do things, and how do you figure out how to coordinate to create value, to create production, to create productivity. And for the first time in history, we're going into this era where we can essentially translate energy into intelligence. And that means that I believe that implies an abundance explosion with all kinds of implications that perhaps we'll leave for another type. But all kinds of work that's limited by cognitive ability, and that's almost everything, will be revolutionized by this revolution. So AI is more than just a technology. It is a step function in human history that, and we're allowed to see it, which is super exciting. But it's going to be also challenging for many people because it's destabilized many things, and it's going to question a lot of assumptions that we all hold as obvious. And so my general longer term view is that let me make the point with an analogy. So at one point, muscle power was the power to do things, and so that really limited our abundance because we were limited by horses and human muscles. And when the Industrial Revolution happened, it allowed us to turn energy into work. So basically, we got away from the limitation of physical muscles. And now the AI revolution, I mean, we've been in this gradual increasing in this direction, obviously with information technology, computing technology, communications technology. We've been getting closer and closer to this singularity, but now we've reached the event horizon. And now we can translate energy into intelligence and cognitive work. Obviously, it's only going to get better. Like there's a saying that the AI we have now is the worst it will ever be. That is correct. And if you've been following, if you compare what ChatGPT was like in November 2022 when it first came out to what developed in 23 and 24 and 25 and 26, it's astoundingly improving. So this is now the first time in human history where energy will get translated into cognition. And ultimately, everything will drop closer to the cost of energy, which has a lot of implications that we'll touch on some of them, but not all. Let's go to the next slide. So now we're in this interesting lull here because SpaceX went public about 4 weeks ago. For those who have been following it, SpaceX is Elon Musk's other company besides Tesla. They made space and rocketry much more affordable, and they're still driving the cost down. And it's incredibly impressive what they've done. It was a private company for many years, probably 15 years or more since it was founded. And it just went public in June. So the company went public at $135 a share, quickly increased to over $200 a share, and now it's getting closer to its IPO price. So as you would expect. So let's say that there are 3 huge IPOs expected this year. SpaceX was one. And now that one is already public. So we have some data to look at and share with you guys. And then the next 2 that everybody's looking at is OpenAI and Anthropic, which is respectively the company that created ChatGPT and the company that created Claude, which most of us use probably both. The one thing that a lot of investors miss is that when IPOs come public, as Sam was saying,
I think we lost this connection.
For the CEO and the CFO and the boards of the companies taking them public. This was many years ago before I started Ridgewood Investments. So I got to see Wall Street from that perspective. Sort of, I saw how the sausage was made and I saw how the bodies were buried. So I know that there's usually a hype cycle, and the more famous, the more people that are excited about an IPO or know about the company or interact with the products, which I mean, I would say that the AI companies are the AI companies are the most probably they're the fastest to ever get to this level of usage, the number of users, the amount of revenue, et cetera. So I would say that the awareness and the interest in these IPOs is higher than perhaps any other company, and SpaceX was similar. So that's why they're 3 of the largest IPOs in history and have also raised the most money. SpaceX raised, by the way, close to $80 to $90 billion in their IPO, which is again by far more than any other company had ever raised. So not only the valuation was higher, but also the amount that they raised was higher as well. So let's go to the next slide. But here's the thing that a lot of people who are excited about these IPOs don't really realize. There's a lot of evidence that if you buy on the IPO, that more than half of the IPOs, the investors lose money if they buy the IPO. Now, typically, especially for these very hyped IPOs, there is often a first day or first 2 days or first week jump, and then there's a decline. So now some people say, well, why don't I buy it and sell it? And you certainly can do that. That's a different type of game. It's more of a speculation. We consider ourselves long-term investors, so we generally don't want to speculate. And so what now, like take SpaceX, for example. I think SpaceX is an excellent company. I think SpaceX will do well, but I was not a buyer at $135 a share. Is there a price at which I'd be interested in SpaceX? Absolutely. And because of the fact that 6 in 10 IPOs do lose ground over 6 months and many times even over 3 years, there's plenty of opportunities, especially in these very hyped companies, to, if you think that it's a great company and a quality company, to buy it at a better price. And so that's an important thing to keep in mind and not get caught up in FOMO, which is a sort of a young person's meme of the fear of missing out.
I
I'm not. Yeah, go
sorry.
ahead.
I just wanted to add, the way that the IPO kind of the way that it's structured is that typically, and SpaceX was a little bit different because the public was allowed to get in on the IPO as well, but the banks will go around and try to gauge what price the funds that will be participating in the IPO will buy the stock at and are comfortable paying for that. And the public historically has never been able to participate before the stock starts trading. And then what happens after that is the banks ideally try to price it in a way because they're going to their best clients and offering their best clients the most interesting and attractive companies that are IPOing. And so they want them to make money as well too on it. And that's why they try to price it lower than what they think the rest of the market will pay once it starts trading, so that the funds that get in initially before it starts trading can make that 10-15%, and they get out. And that's my experience as to why there's a pop at the beginning and then the stock starts dropping afterwards, is because they're trying to price, the banks are trying to price it that way.
That's a good point, Sam. And there's so many people in investing that don't do well, and it's because one of the many reasons. And there's certain principles that you're supposed to follow, that we follow at Ridgewood for ourselves and our clients, that we teach others to follow, that we constantly repeat and emphasize. One of them being long-term investing. But one of the things that definitely to avoid is to follow the crowd, to do what everybody else is doing, to be excited about whatever everybody else is excited about. And that is what herd behavior is. And, we illustrate this with this idea of the sheep falling over the cliff. Interestingly, in researching this, in 2005, it's kind of a funny anecdote, in Turkey, there was 1,500 or 2,000 sheep in a flock, and one sheep decided to jump off the cliff, and all of the rest went. And it turned out like 400 or 500 of them died. Then the rest survived because they fell on the pile of the other sheep that had already died. It's kind of a crazy true story from 2005. But so let's not do the investment version of that. That's what we're here to prevent our clients from doing. So this is, we talked about this, that on average IPOs go up on the first day, but on average over 6 months and 3 years, they go down. And there's a reason, by the way, why 6 months is a particularly vulnerable time, because there's usually, when the companies go public, like when I was an investment banker, we would make all of the existing shareholders sign a lockup. A lockup is basically saying to the people who already own the shares before the IPO, hey, you're not allowed to sell the stock for this much time. On average, that time frame is 6 months. Now, SpaceX had an unusual structure. They didn't make everybody sign a 6-month lockup. They have a staggered lockup. So there's going to be shares released at multiple periods before 6 months and after 6 months. And that's kind of an unusual structure. So that's another reason not to, feel like FOMO, because once a company is public, you can buy it at any time. And many of the shareholders that owned it before the IPO probably owned it with huge gains, and many of them are going to want to sell. So very likely there's going to be a lot of selling pressure at some point within the next 6 months, which will give a patient investor many opportunities to buy at probably more favorable prices.
SpaceX even had certain things in their lockup language that was based upon if the stock goes up over a certain percentage over a certain period of time, it released more shares as well too that could be sold from insiders. And I would also say that from a hedge fund point of view, one of the strategies was typically to find if there was a 6-month lockup date where a lot of shares would suddenly become available, that would be a strategy to short the stock and bet against it as well too.
Yep. So here's so we're summarizing, but here's an example of a great company that ended up doing really well. So their IPO was at $38 a share, and that was in May of was it 2000? What year was that? I'm forgetting. But in any case, so when they went public at $38 a share, it initially went down. And so it bottomed at $18 a share. Now, today, that same share has gone up many, many folds. So here's an example of a company that was a great long-term investment. You could have bought it on the IPO and you could have done really well if you held on, but you had to survive a significant drop, which many people have trouble with. And there was better opportunities to buy that if you had just been patient and waited instead of buying on the IPO. Let's go to the next slide.
So I would just add to on Meta, like if you read a lot of the Wall Street Journal articles, one of the things that they say was a busted IPO is that it didn't have that same pop that most other IPOs had. So Meta went back and was like blaming the bankers as to say, hey, you priced this incorrectly at the beginning. So that was just something else to add in terms of that IPO. That was pretty unique.
Right now in this slide, there's many private companies. They call them unicorns. So these are private companies that are in the private market valued at over $1 billion. And so if you see how many of these companies there's over 1,500, 1,600 of these companies. And there's new ones coming every year, and then some of them go public. So there is a huge amount of value in the private markets. And so this point that we're making about you don't have to rush into IPOs with FOMO, and you have to be careful, is applicable not just to these three companies, but really to the entire forward pipeline that probably some of them will go public. So let's go to the next slide. So OpenAI, and both Anthropic and OpenAI are extremely impressive in terms of they have reached levels of revenue and user base faster than any other technology in history. So to give you a sense, OpenAI ChatGPT has over 900 million weekly users, an incredible number, over 2 billion in monthly revenue. Anthropic is on a run rate of 69 billion of revenue. And we're talking about a company that had like zero revenue like 5 years ago. Like I think Anthropic started like 5 years ago. So if you look at the progress and how quickly, just to give you a sense, like Ridgewood, I started Ridgewood 24 years ago. So here are companies that are starting 5 years ago that are becoming the most valuable companies in the world within 5 years. So incredible rate. But at the same time, there's an incredible amount of spending that they have to do. And this is one difference with the AI as opposed to the other technology waves, is all these other companies, Google, Facebook, whatever, extremely profitable, not at the time that they went public, but basically their businesses do not require a lot of capital investment. And the big difference with AI is it's extremely capital intensive. So while OpenAI has a monthly revenue run rate of 2 billion a month, or say 20, 24, 25 billion today, they have forward plans to spend $600 billion, just OpenAI, on compute through 2030. So that's only covering really the next 5 years. So an incredible amount of money is needed to build out AI, because AI, unlike all of these other waves, requires a tremendous amount of money to build out the data centers and all of the hardware and the other aspects that enable this intelligence to basically serve so many hundreds of millions of people. So that's a big difference between what's happening in technology now compared to all of these companies that we're used to is a seismic change in terms of how much capital is going to be required against this demand that's getting created. Let's go to the next slide. So, I mean, we're talking about probably the largest market in the world which is cognition, right? So we're saying basically, hey, if intelligence was available at some reasonable cost, if you didn't have to have it from human beings, what's the market for that? And what you're already seeing is that the generative AI market, in terms of actual revenue being generated on a run rate basis, is already close to 200 billion. And the trailing 12 months, it's already generated 110 billion of revenue. But again, against that 110 billion of revenue, you have trillions of dollars of spending to create the data centers. Now, a lot of that spending is in anticipation that this growth rate will continue, which it likely will. So let's go to the next slide. So here's an example. I think we had a question from one of our attendees or guests, saying, "Hey, can we go into the financials of these companies?" Anthropic, which is the faster growing of the two, and this is a quarterly chart, not even annual. So if you their gross revenue has gone. I mean, then we have some projections in here, but the projection is that roughly 2 years ago, just over 2 years ago, their revenue was $59 million for a quarter. And at the end of this year, they're projected to do $30 billion for a quarter. So it's an incredible amount of growth in a very short period of time. Another interesting thing just to pay attention to is at the bottom there, what we show is how much they're able to charge for every million tokens, and how much it costs them. The inference cost is for that same amount of tokens. Tokens are kind of the basic measuring block of AI, and as you can see, the cost that they can charge is going down exponentially. So just in 3 years, the cost has gone down almost 90%. Fortunately, their cost is also going down faster than that. So they're still maintaining a margin between their cost and the amount that customers are willing to pay. Let's go to the next slide. But here's the thing that I don't think a lot of people are talking about, and I don't think that most of you guys who probably use AI is probably seeing it. So in this chart, we're showing what market share do the U.S. companies, which is, of course, OpenAI and Anthropic, but also includes Google and Microsoft and Meta and Oracle to an extent, and a couple of others. But basically, most of the share, and Grok, which is Elon Musk's company, and that one is part of SpaceX. So if you look at the green bar, you can see that the United States companies have still more than half the market share. But you see the fastest growing share is actually the red line. And what that is the Chinese AI models. Now, there's about 4 or 5 or 6 of them. The interesting thing about the Chinese ones is, for the most part, they're all open source. And that means that their costs and their capabilities are almost matching the US ones, but the costs are much lower. And so that's why they're growing their share, because basically users, if you use the Chinese models, can get close to what they call frontier models. So basically the best model in the world is whoever it is. Today, it's probably Anthropic or Claude. But if you use the best Chinese model, the cost is just a little bit, the performance is just a little bit less. It's almost as good, but the cost is a lot less. So that's why their share is growing and the share of the pioneers, the innovators, is shrinking. That's the reason, because of cost, basically. So when you think about these IPOs, that's a competitive threat on the horizon. Is, hey, ChatGPT and Claude are having very strong competition from the Chinese competition at a much lower cost. And by the way, the same thing has happened in electric cars. So even though Tesla pioneered electric cars and still has the market share in the United States, the Chinese electric car makers are now very good, and they have great share all over the world. Actually, they're banned from the US. That's why we are not seeing a lot more Chinese electric cars. But as soon as that ban gets lifted, they'll take a big share of the market here.
I would just add in terms of models, if you go to a website called Hugging Face, that'll give you an example of how many different models there are out there. It's kind of like a website that shows almost every single model that exists, whether it's open source, Chinese, American, whatever. And so that's one thing. And the other thing in terms of models is now you're seeing these companies like Claude and ChatGPT. When you prompt it, it will try to decide what's the best model to actually use. And because it doesn't want to use a crazy powerful model for a task that's not that difficult to do. It wants to use a cheaper, lower cost, less energy intensive model for those type of tasks. And if you go down the rabbit hole of AI, there's there's certain companies like Perplexity, or even you can use OpenClaw, which I was playing around with. And a lot of what that does is it allows you to choose from multiple models for different tasks and say, hey, this type of task, use a cheaper model that's open source, while more strategy, deeper thinking, longer stuff, those are the ones where you want to use the more powerful, more expensive Claude models or ChatGPT models.
So here's an example of, we'll talk about this later, but there's not just one way to invest in the growth of AI. In fact, there's many different layers, which we're going to show you the layers. But here's NVIDIA, which is playing in the chips layer. And so one reasonable alternative is to say, okay, well, I don't have to buy the model layer. I can buy something in a different layer. And NVIDIA is an example of one such company. Let's go to the next slide.
Hey, Ken, we got a question about comparing with the financials of Anthropic
Sure.
with SpaceX. I don't know if you want to talk about that.
Oh yeah, sure. Yeah, very, very different. We don't have a slide about the SpaceX financials, but I do know the numbers. So basically, SpaceX has actually 3 or 4 businesses. When they went public, obviously they told the story about their future growth, and their first and main business was the launch business. So the launch business is where they're launching satellites into space at a lower cost than other people, because they pioneered reusability. Before SpaceX, every other rocket you could use it once, then you have to throw it away and build another rocket, which made it very expensive. So SpaceX pioneered reusability. They're reusing the rockets again and again. And sorry, I think I did you guys hear that about the reusability?
Yes.
Yeah. So they pioneered reusability, and now they're driving the cost down. So when SpaceX went public, just to give you a sense, they went public at $1.77 trillion. That was 94 times their revenue. It's a huge multiple, almost 100 times how much sales they're making. We're not talking about profits, we're talking about sales. So of the sales, 4 billion was coming from launching things to space. About 10 billion was coming from their second business, which is called Starlink. That's providing internet through satellite, so internet connection through satellite. That's their biggest and most profitable business today. And then they were projecting and telling investors that, oh, we'll have all of this wonderful revenue someday through AI data centers in space. And that's probably the one that everybody got excited about. And so because of that, people were paying almost 100 times their sales, which is a very high multiple. Now, in contrast, to your point, if Claude, if we believe the projection that at the end of this, and which seems plausible, that at the end of 2026, and by then, so they're expected to go public in October. So by then, if they do go public in October, the quarter will end. It would be the next quarter after they go public. If their revenue is $30 billion for that quarter, and we assume that we can multiply that by 4, that's 120 billion of revenue on a run rate basis of that last quarter. And they're talking about a $1 trillion valuation. So that's like a little less than 10 times sales, but that's sales. Now, if you count the amount of investment that all these companies have to make in building up their AI data centers and their access to capacity, it's many, many multiples of their sales. So you have to really make a leap of faith. And so hopefully that answers the question. Right now, these top few companies, 10 companies in the market, are 40% of the indexes. And it's a self-fulfilling sort of very pro momentum type of approach, because everybody buys these funds, the funds buy these 10 companies, the value of the 10 companies goes higher, which makes the input into the index higher. So it becomes a self-feeding loop, which is not based on the merits of those companies. And so it looks like a wonderful thing to do, but there's a growing amount of danger with just following the herd and going into these. So on the other hand, I mean, we believe in diversified indexes and things, but we also believe that it can be very good if you know what you're doing, if you do your homework, et cetera, to buy individual companies that you've researched and thought about, hidden gems. So by the way, another corollary to this is that while these 10 companies are getting all the attention and getting 40% of the money, there's hundreds or thousands of other companies that many good quality companies are cheap because money is flowing into this excitement for AI, and it's leaving a lot of other good companies behind for a lot of different reasons. Let's go to the next slide.
So just on that point, the market.
Sam, let's
Okay.
move on because I'm looking at the time. So the way that we look at individual companies is these criteria. This is what we use as our filters. One is, who are the people involved in the business? How good are they? What's their values, et cetera? Then we, of course, analyze the business itself. What's the future of that business? What's the growth potential? How immune to competition is it? What's the price that we can buy it at, right? The business could be great, the people can be great, but the price can be too high. That's often the case with IPOs, as we're sharing. And then what time frame? We're really long-term investors, and we find that the best results over time with the lowest taxes happen if you commit to long-term investing for a long time frame. Let's go to the next slide. So one of the key important questions in this AI context is, if intelligence is becoming abundant, what is still going to be scarce? And whatever stays scarce, that's where more of the value will accrue. Value tends to accrue at the bottlenecks. And so here's our sort of one take at some of the things that will still have scarcity. Interestingly, scarcity can be natural or artificial. It's not, and so, I'm not going to go over all of these things, but for example, right now you're seeing shortages in power, in land for data centers, and these things, and so there's value accruing in all these places. We don't have time to really go into all of these things, but this is an example of some of the areas where the AI explosion and the abundance that comes with AI that we think will come will create opportunities in these other areas. And that also means that opportunities to buy individual companies. Let's go to the next slide. So we talked about this, and we're going to give you this framework. I think it's super helpful, is that AI is not just one layer. It's a layer cake. And so there's many different levels at which one can express a optimism about the growth of AI. So at the very bottom layer is physical, power, land, the physical build out. The next layer up is the chips and the compute. Then the one layer up is the guys who take the chips and the compute and actually sell the cloud platform built upon that. So layer 4, which is what our original topic is about, OpenAI and Anthropic, is actually at layer 4. And then above them, right, OpenAI and Anthropic have enabled other applications and other companies to build upon their AI models. And even above that is all the companies that use AI to increase productivity and increase their success, hopefully. But that's going to be a mixed bag, because there's going to be companies that are very good, and there's companies that are going to benefit, and there's also companies that are going to potentially lose their business. So I think this is a very helpful framework. And this is Jeff Bezos had this great quote, which I remember reading many years ago. He says, "I often get asked what's going to change, but I almost never get asked what's not going to change." And he says, I tend to focus my energies and my focus on what do I know isn't going to change. And if it's not going to change, then I can focus on being great at that. And so that's, I think, a nice clue for where opportunities could be for investors like us. Let's go to the next slide. So, we in Ridgewood, we are grounding our approach in timeless principles. Human nature isn't going to change. Scarcity of certain resources is not going to change. Capital allocation is going to be important. Compounding is always going to be important, and it's a great way to build wealth. Focusing on safety and margin of safety and not taking unnecessary risks, always important. So these are the timeless principles that aren't going to change. Now, the challenge with AI is it's probably changing. Everything is changing faster than ever. So in a domain which everybody's excited about, which is changing faster than ever, it's very easy to get burned. And it's very much like if you engage in it, especially if you do it by following the crowd, then it's very much like playing with fire, because the rate of change is extremely fast. And it takes a lot of thought and a lot of effort and the right price to find those few opportunities where we can say, hey, we think this part is actually going to benefit from AI without being subject to the fast changing obsolescence loops that are going to happen all over the place. And I mean, you're already seeing it, right? Like just ChatGPT was by far the #1 leader. And Claude came just really within this year. This year is the year when Claude sort of out executed OpenAI and just got probably half the market share or more and a higher valuation. Nobody saw that coming, a year ago. That's just an example. The Chinese models, last year, the Chinese models came out, surprised everybody with much cheaper inference costs. Nobody saw that coming. So there's going to be a lot of this kind of change, and that means one has to be very careful or it's very easy to get burned. And, that's the other part of the challenge. I won't go into all the detail, but, that Buffett has a thing, which I agree with, which is you should invest in companies that have competitive moats so that their competition can't hurt them and they can continue to have good pricing power and good profits. Well, technology makes that harder. And you saw this in multiple waves. When the internet came out, look at all these businesses that were strong businesses at one point: newspapers, travel agents, encyclopedias, video rental stores, music CDs, all got killed. In the smartphone wave, taxis and paper maps and point and shoot cameras and alarm clocks and, many retail stores, right? They got hurt pretty badly. Some survived, but the majority got impaired. And so the question is, in the AI wave, is it going to be different? No, it's actually going to be faster. And there's many, many things which we thought were safe, which are going to get competed against because now intelligence and cognition are going to become accessible to everybody, not the domain of just a few. Medical things, for example, people today are using AI. I'm sure many of the people on this phone call are using AI to question and to learn and do things. I don't know. That's not a substitute for knowledgeable medical doctors and things, but it does create more and more power in the hands of the consumer, which can be misused or it can be used for benefit. So, both very important. Next slide. So, for those of you that are on here, we advise clients to do long-term investing. We do a lot of work to find investments, and we try to find these diamonds in the rough. And you have to turn over a lot of rocks to find those few diamonds, and then you have to be patient, and you have to focus. And but there's a lot of advantages to doing that, and that's what we enjoy doing, and that's what we enjoy doing. So we love to do it. And if you understand some of the value of it, then and you're not in a position to do it yourself, please come and talk to us. So here is a, so one other thing I wanted to just give as a resource to you guys, and we're open to questions now, is I'm a very big, so obviously we live in an age of social media, and a lot of social media like TikTok and Instagram and so forth is really not, let's say, very meaty or very valuable. But I think, for example, I asked this question, it's an interesting question, which is if you could only keep one or two social media platforms, let's say two, which two would you keep? And I'm saying for your life. So you pick two and then you could never get access and never get to use the other ones again. The two I would pick, one is not surprising. I think it's probably number one for most people is YouTube. But the second one I think is one that a lot of people haven't heard of, which is called Substack. So Substack is long form articles. I find that that's the second one that I would keep, believe it or not. I would not keep Instagram. I would not keep TikTok, or I don't hardly use those anyway. But I would not keep LinkedIn, though LinkedIn is great. I would keep Substack. And so I do write long form articles on Substack. If you guys haven't heard of Substack, or if you're not really active on Substack, I would recommend to check it out, to download the app. And if you scan this code, you can follow me. I have about 10 very long articles on Substack. I add to them at least once a month. So please check it out, even just for yourself. It has wonderful content. And it's actually valuable. It's meaty. It's things that you can think about and actually get value out of. My Substack is called Compound Ideas. And I guess if you take a picture of this QR code or scan the QR code, you can follow my articles there. And the next slide. Is there a next slide? Or I guess that's it. So
That's it.
Yeah. So, and we also want to give you guys more value. So we have a report that we've prepared. For some reason, it says 3 pages. It's actually longer. It's probably going to be like 10 or 15 pages. But it has some additional stuff that we weren't able to cover in the webinar, and some other value for you guys. So you can get that by taking a picture of or scanning this QR code. And we are now open for questions. Hope this was valuable and helpful, and we're happy to sit here and answer questions even past our 1 o'clock time. So please put any questions you have in the chat. One question, easy one, is will the presentation be shared? So yes, you'll each get a copy of a recording of this webinar, which you can view on replay, which obviously includes these presentation slides, which you'll see in the replay as well. So what other questions do you guys have?
Yeah, so you see the question, but I would just kind of add. I'll ask a question. When we look at, you talked about the moats. When we look at investments, is there something either in the AI space or something, maybe a sector, or like maybe walk us through an example of how you think about a moat in this space, and what we look for in an investment that's effective.
Yeah, I mean, a moat is something that gives a company the ability to, for example, keep its customers or raise prices or so forth. And so the thing is that each technology, the moats, like as we said in that earlier slide. So I'll give you an example. Like if you read Buffett's news original letters, one of their investments was called the Buffalo News. It was the paper. It was the newspaper in Buffalo. And newspapers had very high moats because once you were the paper in Buffalo, you were the one that everybody reads. All of the merchants in your area, if they wanted to reach their customers, would advertise on your newspaper. There wasn't really any other game in town. And if a competitor came and tried to say start a new newspaper, right, it was very difficult, and most of them would it would always fail because they've already aggregated. So that's called sort of a network effect. So that's a one type of a moat. And there's like 6 or 7 different types of moats that the business literature talks about. But what happened? So newspapers were wonderful businesses for probably 70, 80, 90 years. Then the internet comes around and starts chipping away. Now, newspapers made money three ways: classified ads, um, you know, big ads like from merchants, and subscriptions. And the internet gradually eroded all three to where most newspapers can't have any of them. Yellow Pages was another moat, similar, right? So that was in that era. Taxi cabs got competed with Uber. Now the question, it's not an easy question, which is, okay, now that AI is here, and as AI gets better and better, what moats are going to still be strong when all is said and done? Well, there are definitely some that are going to be strong, like that I can say with confidence. And if we go back to that slide that we had them on there, that was really the purpose of that slide. But for example, let's take something like the New York Yankees or the New York Giants or something that a sports franchise. People will still care about their sports teams. You basically no matter what, right? So that moat will not get eroded. Now, I don't know. Is it possible that robots will play football or baseball? Yeah, it probably is, and they'll probably create a robot league. But people are not going to want to stop watching human beings play sports. So that is a moat that's almost unassailable, right? And you even had somebody try, like way back in the day, somebody tried to create a competing National Football League, and it was called USFL. Actually, interestingly, I remember Donald Trump had the team in New Jersey. It was called the Generals. Well, that didn't really work out because people have their NFL teams. They're not looking for a second, one they never heard of, and it's a network effect. Like the best players are going to go to the NFL. The ones that can't make the NFL are going to go to the other one. Well, who wants to watch those guys? So that's an example of a moat. And so here we've taken a shot at saying, here's some of the things that will get crushed, and what are the things that won't? So the NFL teams is like one example, but there's other examples. But you really have to, like I said, you have to look at a lot of rocks. You have to read a lot. You have to search and think, and certainly certain natural resources, for example, could be a moat. It's going to be a while before robots can do everything humans can do. It's much shorter period of time that computers can do all the thinking that humans can do. So things that are physical probably have some kind of moat, at least for the next decade or two. And similarly, there's other things, but that hopefully answers that question. What's our next question? When are they going to make money? I think was.
Yes.
Oh wait, let's see. That was a question. Can you post the QR code? If you were to use AI to build a trading system, what would you train it on? That is not in my wheelhouse. I'm a long-term investor. I don't trade, and I don't do trading systems. I know about that area, but it's not something I actually focus on. But many other people do. So that would not be something I could answer.
I would just add to that there's probably like these huge quantitative trading funds that have been doing it for years and are well ahead and much more capitalized than what we would be able to compete on, or any of us.
So for example, I know somebody at Jane Street indirectly through my friends. They made like $40 billion last year. They're using AI and going to town. Same thing with Citadel. So this is one of the reasons, over the years, like over many years, I've always met people who are interested in day trading. And the reality is, I always tell them, like, be careful. It's probably a great way to lose money. And most of them do end up losing money. Well, why is that the case? One is that, you're speculating all the time. So speculation is not a good way to make money over the long run and keep it. But secondly, you're competing against people who are much better at it, have more computers, have more resources, have more smart people at their disposal. So to try to compete against them seems kind of daunting. Whereas all of those guys are focused on millisecond trading. So if you're willing to take a long-term horizon, you actually have an ability to do something they're not even interested in trying. Is your recommendation not to buy the OpenAI IPO? I'm not making a recommendation on the IPOs, but I'm showing you the history of what happens with most IPOs, and I'm also showing you all of the things that you have to be careful about. Again, everybody's different. Maybe you want to flip it day one. It's not a game I do, but I will not be buying the OpenAI IPO at that price. But that doesn't mean that I don't think it's a good company. But I do think that if you look back at our 6-layer model, which we'll include in the report, that if you get our report, I think that there's opportunities in other layers that are more interesting and less risky and available at a better price. I want to see where are we going to make more. I can't answer that one.
I would just
When are
add
they
on
going
the
to?
sorry,
Yeah.
I'll just add on the OpenAI aspect. For me, also the barrier to entry also is not fully clear there yet, and I think Ken was bringing that up a lot with like the competition from the Chinese models and the other cheaper models as well. Because the question is, how much are people willing to pay for the lead and the improve, like pretty much how far ahead OpenAI or Anthropic and Claude are in terms of their models being better than the Chinese ones or the cheaper ones that are behind. So that's still to be determined. And I also would also add to that that valuation to us matters a lot as well. So depending on the price, I don't think it's been priced yet what valuation OpenAI is going to come public at. But to some degree, there is a price for it where we think maybe at some point it could become attractive. But generally, I think based off of what we've seen in the private markets, that's something right now currently that we find better opportunities in the market to invest and put capital at instead of OpenAI. Ken froze.
There's still a few more questions if you want to hit on them, Sam.
Let's see. Sorry, I wasn't keeping track. A lot of questions came in.
What sector won't survive AI?
If you go back to the moats page, the moats slide. So education is one that we think will be, I wouldn't say there's stuff that won't survive. I think there's stuff that'll be more heavily disrupted by AI. Ken, are you back with us? So I think there'll be more stuff that'll be more heavily disrupted by AI. For instance, like software. Software has been disrupted already. The valuations have come down a lot on software. But software is not just developing a software. There's a lot more tiers to just the development side. There's maintenance, there's sales and marketing as well, and there's a lot of making sure that it works properly, testing as well of software. So we're currently finding interesting opportunities in software companies that have been priced and valued down, but we believe that it's not just the development of software that the cost of development has come down, but we think some of these companies can actually use that to their advantage, and develop faster and improve their products and create and still have a barrier to entry where it becomes too difficult to swap them out, especially from larger organizations.
Yeah, and I want to also jump in that we already know that the model layer is not probably having a great moat, because we already have 2 data points. One is that OpenAI was by far the leader, and Claude came in, Anthropic came in, and basically so far kind of ate their lunch on a competitive basis. And now you're seeing that the Chinese models are doing the same thing to both of them. So it doesn't seem like the model layer is really a layer with a lot of moats. It's hard to imagine how they could have a lot of moats. That layer seems quite vulnerable, and that's why one has to be careful about investing in OpenAI and Anthropic when there's these other areas that might actually have better moats. The other thing, somebody I think asked this question, that what sector won't survive? Well, there's a big difference between surviving and being a good investment for investors. And so I'll give you 2 examples of that from history. So railroads and airlines and even cell phone technology were all incredible innovations that created tremendous value for humanity and the economy and everything. But investors in those areas didn't really make that much money. So there's certain things that structurally aren't great to invest in, even though they are absolute. So the people who invested in them and were excited about them were absolutely right that they would transform the future. but they were wrong that in doing so, they would actually benefit them as investors. And that those are two very different things. That's not necessarily always obvious to people. AI is a really big change in the world, so it's going to affect a lot of things. It's not obvious what everyone uh, it's not obvious who are the winners and losers going to be. We'll only know that over time. So we're trying to think about it and find those few things that we feel we can be confident about. In general, most things are too hard to figure out, and we'll have to just sort of wait and see. One of the questions is, Ridgewood has a fee-based model. What are my costs all in? How do you select investments to minimize? So one of the things that a lot of people don't realize when they're working with other firms is that there's a lot of investments with fees that you don't realize you're paying. And one of the things about which is good about our approach is when we buy individual stocks, there are no extra fees. It's only the fees that we're charging, and that's paying for the research and the thinking and the approach that we take and the advice that we're giving. So it's really a fiduciary based model. It's very much designed to be the way I would want it to be if I was if I was somebody that needed an advisor. Next question. Any thoughts about the fact that a lot of technology and data centers only have useful spans that last a few years? Yes, this is a very, very good point and a very astute point. So data centers are, as I mentioned, like as much as these companies are generating, let's say Anthropic is close to generating 100 billion of revenue, they're going to be spending many multiples of that, and most of that money is going into data centers. So what goes into a data center is servers, chips, memory, power, cooling. You need a certain amount of land in a building. And by the way, and another interesting point we didn't touch on, a lot of states, New York State just did this. I think they were the first state that passed it. They said that they basically put a ban on building any data center over 50 megawatts, which is like not that big in the data center world, for now. And so many states, there's a lot of backlash which we didn't see coming about a year ago. People do not want more data centers, in part because they're worried about their power prices going up, which is a reasonable worry, but in part because they're like, hey, this might hurt me, or this might be a problem for my community or whatever. So there's now an anti-AI backlash, which is really just starting, that we're going to see how that plays out. But it is true that there's trillions of dollars that's going to go into these data centers, and most of those trillions of dollars is going to be buying chips and hardware that depreciated, at least historically, very rapidly. So that means that the expense structure of these companies is going to go up very, very rapidly as they spend these trillions of dollars. So while their revenue is also going to go up, it may be that not maybe, it's definitely the case that their spending is going to go up even faster. And then the question is, will the revenue ever catch up? And this question, which was very astute, is related to that, because if, for example, the chips and the servers have to be replaced within 3 or 4 years, then that will just require another trillion or trillions of dollars to be spent. And that means that they'll never actually get a return on that investment. So that is a very important point that we don't really fully know the answer to. There's arguments on both sides.
The one corollary and the historical example to that is crypto mining. There's a lot of there are a lot of crypto miners that are actually converted now to these AI data centers, but especially the mining equipment, they historically would depreciate it over 3 to 4 years, and that was actually too aggressive. I mean, too aggressive. They should have actually depreciated them faster, and they ended up being usually like after a year, you get maybe 1 more year of life out of that before it became obsolete and not.
And there's a reason for it. Just technology moves so quickly. So the chips that are the state of the art chips today, in a year or two, are not the state of the art chips. So the question is, how useful will they be in a year or two? Question from Hope Byrne: do you think there's enough competition to prevent the Uber experience and massive price increases and service degradation? So there's no question that demand is going to explode and has exploded and will probably continue to, because basically, if you have access to intelligence for low cost, there's probably almost a virtually unlimited amount of things that you can apply that to. But costs do matter. And so to some extent, the price reflects the cost it takes to sustain and afford that thing. And this is related to those Chinese models. So the Chinese models are almost as good, but a lot cheaper. And there's a lot of applications where you don't need the absolute state of the art. I mean, if let's say you can use a model which is 95% as good, but 1/10 the cost, and that's sort of roughly the order of magnitude of like how much cheaper these Chinese models are, then there's no doubt that you're going to do it. Now, remember when so I mentioned like airlines and railroads and things. So why didn't they end up being good investments for investors? Well, the reason is that you don't really care. Like if you take United one day and Delta offers you $50 cheaper, you're fine taking Delta. Like you don't really care for the most part. You just want the cheapest price. And so the question that's implied in Hope's question, or really is really her question, is this business of providing AI inference similar to the airlines? And I think it kind of is. I mean, now to some extent, like if you're using ChatGPT, it gets to know you, or if you're using Claude, it gets to know you. You have all your chats in there. The memory is not great in these systems, but it's coming. And so that could be a little bit of a barrier. But the reality is that I think in technology, they're working on things to basically keep your memory with you. So to the extent that all your stuff stays with you and you can decide which model to use, yes, it's more like Uber where you won't care. You'll just use whoever's inference will give you the best deal, basically. And by the way, right now we use these cloud-based systems, but the models are getting smaller with more and more capability, and the computers that we have on our desktops or phones. So we're really pretty much at the threshold where you could have a model just on your phone. It's not in the cloud, or just on your PC or computer, that can do most of what you want it to do. And if that's the case, why wouldn't you use it? And it'll be a lot cheaper because you're running it. You've already paid for the hardware, so it's just electricity. One more question. When will the AI companies make real money? So I think if you follow along, you'll see, depending on most people are valuing them based on sales, which is not profit. So the sales should keep growing, at least for now, but profitability is going to be a problem when you take into the cost of all of these all of these hardware investments that they have to make, the capex, the trillions of dollars, and then you take into account the point, well, maybe these things that they're investing in go obsolete in a year or two or three. If that's the case, then they probably will never actually make money in terms of actual profits, but that doesn't mean that the stock may not have a big value if you want to flip it. I think that was all the questions. Thank you, everyone, for participating. Hope this was valuable. We really appreciate you guys taking time out of your schedules to invest in learning and engage with us and ask us all these great questions. And hopefully you guys get to follow me on Substack, as well as get our free report that we're offering. And if you guys have follow-up questions, if you have an interest yourself in working with a thoughtful long-term advisor, please let us know. It's what we love doing, and we'd be happy to engage with you one-on-one and talk about that. So with that, we'll conclude the webinar. You guys should get a copy of it, and we are available at any time if you want to reach out.